Hello friends. Last week in my video, I told you that the markets could hit a speed breaker, which came out fairly accurate. Now in this week, I want to tackle the issue about whether the financials, the banking and financial sector stocks are likely to drag the overall markets down. Let's analyze and see what the market holds in store for us this week. In this week, we examine if there is any threat, a statistical threat to the rally, because the financial and banking space commands 35.26% weightage in the Nifty itself. Now, this is the largest weightage any sector holds in the Nifty. Whichever way the sector swings, the broader market swings with it. Now, on my Telegram channel, I've been warning you since many months that the interest rate sensitives or IRS sector stocks are likely to underperform the markets. Feel free to connect with me on our free Telegram channel. You pay nothing for it. And in the search string, you can search for interest rate sensitives or IRS stocks, and you'll see date-wise how far ago I have been warning you that this sector is likely to underperform. And last week I presented you with a scorecard of the returns that interest rate sensitive stocks have been giving you since at least 20 weeks. Now, this is something that I follow up since many months, and it is also there on our Telegram channel, the social media, etc. Now, our models, our statistical and behavioral trading models that we program in-house are basically built to warn us way ahead in advance, to the extent that many people initially believe that we are going wrong. But that's fine. At the end of the day, what really matters is who is right in the ultimate analysis and who takes the money home. Now, check out the table on your screen right now, which basically tells you that interest rate sensitives have been underperforming the Nifty 50 as on 4-week basis, 12-week basis, and on a 20-week basis. The Bank Nifty itself has been giving you lower returns as compared to the Nifty 50. Now, this is something that we will visit in the later kind of graphics also. But what I have proved to you by this graphic is that on a 4, 12, and 20-week basis, the interest rate sensitive sector is underperforming the markets. And yes, to that extent, there is a definitive drag on the overall markets because of that. Now, since October 2021, when I first started advocating investments in sovereign paper, now whether these are sovereign bonds or sovereign backed other investment schemes, I have noticed, and you can see that on the second chart on your screen, I have noticed how the indices have basically given you fairly poor returns. The case in point here is the financial sector services, the Fin Nifty, which has given you 9.35% returns over 28 months. Now, that's lower than even a bank FD rate, or maybe even a bank savings account interest rates. And the profits on the Fin Nifty trading would have been taxable. The Bank Nifty has given you 16.27% return over the last 28 months, whereas the Nifty 50 has given you 18.92% returns in the last 28 months. But not only does the Bank Nifty underperform the Nifty 50 over the last 28 months since October 2021, but it also underperforms the post office term deposit, which is a fixed deposit scheme. And since it's the post office, it is sovereign guaranteed. At 17.59, the post office scheme beats the Bank Nifty. The senior citizen savings scheme, where the threshold has been raised to 30 lakh rupees per individual, also gave you 18%, which is higher than the Bank Nifty and the Fin Nifty. And 2 points that I need to point out here. Number one, if you were a buy and hold futures trader in these indices, you would have paid rollover cost or cost of carry. Old school traders call it badla or financing charges. Now, if you were to calculate even 0.5% financing charge over the last 28 months, you would have paid 14% as financing charges alone. And then come your other execution costs, brokerage, GST, STT, SEBI turnover tax, stamp duty, exchange transaction costs, etc. So all these indices, all three indices have given you negative returns to futures buy and hold traders. Whereas the Public Provident Fund, which is a sovereign guaranteed scheme, and EEE, exempt at all three levels of investment, interest, and redemption, are tax free. It's given you 16.30%. So I could have invested in sovereign guaranteed bonds, in PPF, in post office term deposit, and senior citizen savings scheme, and earned higher returns than the Bank Nifty and the Fin Nifty. Now you know what I'm talking about. Hey, as an investor trader, I'm here to earn the maximum possible returns in the shortest possible time frame and with the least amount of risk to my capital itself. And if I am allocating a certain amount of money to a fixed income portfolio that is outperforming the indices, I would rather raise my allocation to sovereign investments as compared to the indices. Sure enough, individual stocks, especially mid caps and small caps, have given you huge returns. But I'm not saying you should not buy stocks. I'm telling you allocate assets to this segment of fixed returns as well. And realistically speaking, how many multi-baggers do you really own? You need to ask yourself that question too. Now, when you invest in sovereign guaranteed schemes, the President of India is safeguarding your principal and interest. And therefore, the peace of mind that you get cannot really be quantified. I have many friends, and I've posted this on my social media accounts multiple times, who pull my leg and tell me, hey, Vijay, how are your fixed income schemes going? How are your sovereign bonds going? Because they think this is a very boring investment. But over a longer period of time, since October 2021, the sovereign bond yields, PPF and post office schemes, etc., have been giving me higher yields as compared to indices. So I'm relatively better off there. Of course, my stock, commodity, and other asset classes also move side by side. I have made a video on 14th of November 2023, which is titled How Bonds Can Make You Rich. Please do watch that video. The hyperlink to that video is in the description below this video as well as in the pinned comment below. The cost of funds that are rising remains a chronic worry which I have been expressing on my Telegram channel, and feel free to search in the search box on my Telegram channel cost of funds or interest rate sensitives, and you'll see that this is a worry that I have been expressing over the last many quarters. I invite you to subscribe to our free Telegram channel. That's one place where I share all my research, my ideas, and trading strategies in one social media platform, and it's absolutely free. So the sum and substance of this segment of the video is that yes, financial sector stocks, in my humble opinion, do pose a certain amount of threat to the broader markets, and if at all they continue to fall the way they are, there is definitely a probability that the markets may come down a little. And let's not forget a recent media report which was carried by Reuters, and of course it was later carried by Indian frontline pink papers and financial media like Economic Times, etc., that the liquidity deficit in the Indian banking space is at an all-time high of rupees 3,34,000 crores. Now, this is something that has never occurred before. Now, that makes it probable that there are some possibilities of a cash crunch occurring in the banking space at a later date. Do remember that low cost and easy availability of money is mother's milk to a bull market. So what happens when the opposite happens? When there is a fund crunch? I'll let you be the judge. Now, friends, let's proceed to our regular studies that I share with you in the weekly video. And on your screen right now is the weekly market roundup, which tells you that it was the banking space, the bank nifty, which led the downside, and the broader base Nifty 50 brought up the rear. The US dollar index, the Dixie, rose 24 basis points, and that proved to be a drag on sentiments. In spite of a higher dollar, commodity prices were up due to defensive buying in gold and especially in silver. Silver outperformed gold. Crude oil went up, and this is something that I have advocated on my free Telegram channel on 10th of December, that Vladimir Putin, the president of Russia, will play Santa Claus and give you easy trading profits in crude oil at least till 17th of March 2024. When elections are held in Russia, there will be an artificial move to prop up crude oil prices, and Russia will be helped by Saudi Arabia, and so far I have been proved right. The US dollar versus the Indian rupee rose 17 basis points, and the Indian 10-year benchmark bond yield fell by 1 basis point to 7.18. The NSE lost almost a percent in market capitalization. That tells you that the fall was sort of broad-based. MWPL, or market-wide position limits, fell 14.37%, which is routine after expiry. The US indices rallied, all three of them went up, and that kind of cushioned the falls in the Indian markets. Friends, let's now come to the in-house indicators that we share with you. And I start with the market-wide position limits. This is a 20-week chart, and what you are seeing is the MWPL. Now, MWPL is actually the amount of limit utilized by traders as a component of the limits totally allowed by SEBI. Now, post-expiry, there is a routine fall. As you are seeing, every 4 weeks there is a plunge. That is the expiry week fall. And last week, we saw a fall to 26.19%. Now, very simply put, this is the lowest post-expiry MWPL in 5 months. That tells you that traders were extremely cautious. There was nervousness in the undertone. Part of it could be attributed to a short week, because last week had only 3 trading sessions, and therefore people were a little hesitant. But the fact remains that big money bought less and rolled over fewer positions. The next study I share with you are stock and index futures turnover. These are 3 concurrent series, so it is January, February, and March. Now, what you are seeing is that turnover in both the indices and the stock futures have hit 20-week or the period high in this chart. In spite of the fact that it was a short week, the traders have participated wholeheartedly in the fall. That means the savvy traders have been short selling the markets even at lower levels and participating and profiting from the fall. They are prepared for it, and big money knows what it's doing. Can it lead to bigger falls ahead? I would say the probability exists, because the turnover being high in a falling market like this warns of further declines. Friends, I now come to the advanced decline ratio. This is an average of all trading sessions in a week, and it covers 20 weeks. Now, the fact remains that the Nifty fell 1.02%, but the advanced decline ratio went up from 0.95 in the prior week to 1.36 last week. So on an intraday basis, the retail traders seem to hold out a lot of hope that all is well and the markets will go up, and therefore they attempted to fall. But as we know, it is the big money that determines the trends in the market, and therefore retail buying proved to be inadequate. Friends, I now come to the NSE, Nifty and Bank Nifty prompt month futures basis. Now, basis is nothing but the premium or discount prevalent in the futures as compared to spot. And what you're seeing is the Bank Nifty basis at 425 rupees is the highest in this chart. And even the Nifty 50 at 136 rupees basis is also near its period high. Can this basis really sustain? Statistically speaking, I don't think so. So, even if the spot prices don't change as much in the coming week, the futures will underperform the spot on a relative comparative basis. Remember, I'm using the word relative comparative. So, this unsustainably high basis is basically likely to see some amount of decline in the futures, and therefore, you need to be careful about that. Friends, I now come to our exclusive in house indicator, the impetus that you have been enjoying over 3 years in a row now. Do note how both the indices recorded falls last week. And unfortunately for the bulls, both the indices have also clocked higher impetus, which means the declines were accompanied by greater momentum or force. And that tells you that the probability of further falls cannot be ruled out. Now, ideally speaking, the impetus and prices rising indicate a sustained bull market. But if prices are falling and impetus is rising, it indicates further sales or short sales in the offing in the near future. So, this is something that I update on my social media accounts every day, late night. Do connect with me and get yourself updated. Friends, I now come to our second exclusive in house indicator, the lift, weight, thrust, drag index that you've been trusting for almost 2.5 years now. And what you're seeing is that as the Nifty clock declines, the lift, weight, thrust, drag index also fell but remained in positive territory. What does it tell you? It tells you that the MWPL, which means the built up positions, can basically result in bears covering some amount of their shorts to book profits, and that short covering could cushion the declines. But do note, as I have been writing in my live mint column, and last week in my live mint column, I warned my readers that you should brace up for higher volatility. And look at how the volatility spiked. It's a multi quarter high volatility that we have ever seen in one trading week. So, there I warned you that this kind of volatility would be unprecedented, and short covering, as the LWTD suggests, could basically slow down the decline, but it will not. It will not result in a sustained bull market. What is needed to trigger a new bull market or a new all-time high is fresh buying. Unless fresh buying comes, a sustained rally will be evasive. Friends, now that we are done with our in-house indicators, I now come to the bond market, which is something that I have been covering ahead of the equity markets, and I have been basically telling you to ladder bonds since October 2021. Here are some of these screenshots that I've basically shared with you across my social media accounts, telling you to please ladder bonds and invest in fixed income securities. At least that much of your capital is away from high volatility asset classes like equities, commodities, and currencies. So, what we saw last week, as you can see on the weekly chart of the Indian 10-year benchmark bond yield, was that the bond yields basically came down by 1 basis point. But that means the bond prices went up a little, and that cushioned some amount of declines in the bank nifty, because when bond prices go up, banks, which are the biggest investors in bonds, see a mark to market gain. So to that extent, there is a certain amount of relief which is witnessed in banking stocks. And how did our gilt income portfolio fare? So what you can see on your screen right now is that all four gilt funds are now trading near or at lifetime highs. In spite of the fact that Indian 10-year benchmark bond yields are still at 7.17 or 7.18, our gilt funds are doing extremely well. So this is a case of good timing. On 14th of December 2023, when I told you to go and invest in the first tranche of gilt funds, it was because of our in-house statistical trading model that indicated this was time to go ahead. When will the next tranche be advocated to be invested in the gilt funds, or maybe a ladder, even the sovereign yields? Hey, please connect with me on our free Telegram channel. That's where you get the first alerts about our trades. So, friends, what you are also seeing on your screen right now is the chart of the Fin Nifty. See how the Fin Nifty basically, once it peaked out in October 2021, I've marked it with an arrow. It peaked out at 19,778, and in December it peaked out at 21,627. The yield was 9.36% or 9.35% in that period. But look at how the RSI is basically making lower tops. That tells you that there is a negative divergence in the financial sector services index, the Fin Nifty, and probably the financial sector is likely to drag the markets. Here's a reminder of the interest rate sensitive stocks that I have basically shown you earlier as well. Friends, the bond market's done. I now come to the Bank Nifty, which fell on 2 out of 3 trading sessions last week. It logged declines of 2.59%, and the volatility was extremely high. It was screaming high. It reached a crescendo level. And here is a screenshot of my live mint column, which I shared with you on my Telegram channel last week. I basically warned you that the market was screaming that you should be extremely careful. By the way, this happens to be India's first and only media column to offer statistical inputs to its readers. The link to these columns are in the description and the pinned comment below. Please make it a point to read this column. It will help you understand the market better. Now note how on the daily chart on the screen, the Bank Nifty is poised at a critical juncture, which is a previous neckline of a head and shoulder formation. The price is below its month-long moving average, and the moving average itself is trending lower. So that tells me that the short-term outlook is negative as of now. Now, falls are all on large red, powerful bearish candles, whereas rallies are on very small, weak, bullish candles. That tells me that the selling pressure is absolutely high. Now, let's take a look at the weekly chart. That basically tells you that the market, the Bank Nifty, has been falling for 4 consecutive weeks, and candle size last week was fairly high. The 25-week exponential moving average, which doubles up as a 6-month-long holding on cost of an average bull, is violated on a closing basis. Now, that is not good news for the medium-term retail investor. I would watch the 44,000 or 44,200 level support very, very carefully in the coming few weeks. Now, friends, in the week before last, this index was number 3 on our most volatile counters list based on statistical beta rankings that we maintain in-house. It jumped 1 spot to number 2. Now, a big index like that, being the second most volatile counter, is not good news for retail traders. It's a challenge. Now, last week, I advocated an estimated range between 47,350 on the upside and 44,775 on the downside. Admittedly, the Bank Nifty fell 346 points below the support and tested 44,429 levels. That's less than a percent, but it was breached. In the coming week, I estimate a range between 46,250 on the upside and 43,525 on the downside. Friends, do keep watching the daily, weekly, and monthly pivots that are updated on our free Telegram channel. It'll help you as an intraday swing or buy and hold trader, both in futures and in the options segment. Friends, the Bank Nifty done. I now come to the Nifty 50, which fell 1.02%. And like the Bank Nifty itself, it fell on 2 out of 3 trading sessions. And volatility was extremely high, like I've said before. Now, the price, as you can see on the daily chart, is below its month-long moving average, which itself seems to be turning sideways. Now, that tells you that this could be calling for some consolidation. And do note what I have been telling you since at least last 3 weeks is the 261% extension, Fibonacci extension, which is placed at approximately 22,200, is acting as a resistance. Now, unless the bulls take the Nifty past this 22,200 resistance mark, the outlook is likely to be slightly nervous. An overhead supply, which is selling coming in from traders who are stuck at higher levels, might remain persistent. Therefore, the short-term outlook is turning slightly nervous. Now, I turn to the weekly chart, which tells me that this was the second consecutive week of declines. And the week prior, I had told you that there was a bearish engulfing pattern. As you can see, the red candle overshadowed the body of the smaller previous bullish candle. The 261.8% Fibonacci extension that you can see at 22,200 remains a very tough short-term hurdle in place. Last week, I told you the big gap between the price and the 25-week exponential moving average, which indicates a 6-month long holding on cost of an average bull. That big gap between the price and average tells you that there is a possibility that some consolidation must occur. Either the price goes sideways and the moving average catches up with the price, or the price falls to touch the moving average and then bounce back again. So that hypothesis has come out true, and the index is basically trying to bridge the big gap between the price and the moving average. This is called mean reversion in statistical analysis. And what you're seeing is mean reversion occurring in the market right now. This is all thanks to the financial and banking sector space, which constitutes 35.26% weightage in the Nifty 50. The medium-term outlook in the Nifty is relatively better than the Bank Nifty and is positive as of now. Friends, in the week before last, this index was placed at number 11 on the most volatile counters list. On statistical beta ranking that we maintain in-house, it jumped 2 notches to number 9, which is not good. Volatility going up is a challenge to a retail trader. And last week, I advocated an estimated range between 22,050 on the upside and 21,125 on the downside. Note the low was 21,137, 12 points above the support that I had estimated. This fine-tuning is all thanks to our statistical model IBEX, which we update in-house. In the coming week, I estimate a range between 21,850 on the upside and 20,875 on the downside. Friends, do keep watching the daily, weekly, and monthly pivots that we update on our free Telegram channel. My contact coordinates and the Telegram link comes at the fag end of this video, in the description below this video, and in the pinned comment below. Friends, I now come to the last bit of statistical analysis that I use to gauge the retail risk appetite in the market. And what you're seeing is a 20-week chart of the turnover constituted by the 4 segments of the derivative space in the market. The index futures contributed 3 basis points increased turnover. It is indicated as a blue line. The stock futures turnover was higher by 24 basis points. It is indicated as a red line. Now, most of it is because of the derivatives expiry. Now, you square up your futures in the January series and you reinitiate that exposure in the February series. So, double turnover is recorded. In the options space, what you are seeing is index options saw 72 basis points jump in the turnover contributed. It is shown as a green line. In the stock option space, there was a big decline of 99 basis points in the turnover contributed. So this is shown as a purple line. What it tells me was that futures turnover rose because of the expiry, but the options turnover. Now, retail traders tend to be big options fans. They tend to trade options a whole lot more aggressively. And index options are less volatile, number one. Number two, they demand smaller amount of capital. If you're an option writer, the span margin is smaller in indices as compared to individual stocks. So the fact remains that stock options turnover fell tells you that risk appetite was lower. Also, read that in conjunction with the falling MWPL, which is at a multi-month low post expiry, which I explained to you earlier. Net, I think retail traders are somewhat nervous. Friends, I now come to the last bit of this video where I share my own trading blueprint. My focus has been on public sector units, especially public sector banks, and that has been so since the last many months. As a matter of fact, I've recorded a video as to why I like PSU stocks. It's an evergreen video. The hyperlink to it is in the pinned comment below and in the description below this video. So I will continue to trade these public sector banks. Do remember, I have updated a list of stocks where the MWPL is so high that any fresh build-up or even unwinding will result in very large price moves. And if you notice, most of these are PSUs, public sector units. This list is available on our free Telegram channel. The hyperlink to that update is in the comment below. So do update yourself. Please be careful when you trade these half a dozen counters, because price volatility might just send you out for a toss. Now, I will try to seek opportunities in theta decay on interest rate sensitive stocks, which means option writing, especially where the delta is 0.65 approximately in the prompt month option series. I would not like to venture out in the mid-month series as of now. As I mentioned earlier, oil may rise because like I said on our free Telegram channel, on 10th of December, Putin is playing Santa. He is rigging up oil prices ahead of Russian elections, which start on 17th of March. You can tell me that there are problems in the Red Sea and the Houthis are attacking ships, etc., because of which there are supply side constraints. But hey, geopolitics is all about triggering these problems. So is it a coincidence that these problems are occurring before the Russian elections? No, I don't think so. There is a possibility of some short covering in metal stocks as bears attempt to book profits in the absolute near term. In the energy space, I will continue to seek opportunities in out of the money call writing, option writing, especially in oil and gas, but more in gas, less in oil, because oil, I will wait for some more alpha or increase in price in the futures space before I write options in the higher strikes. And the yields have to be really high to justify that risk that I'm willing to take. Overall, the beta or volatility is likely to be above the level where an average retail trader is comfortable trading. So my traded volume and my footprint in the market will be light. I continue to remain cautious where big turnover is concerned. And like I said, do consult that list of 5 or 7 stocks that I have compiled, which are going to be more volatile in February as compared to Jan. As more and more ideas occur to me, I will update them on our free Telegram channel. That's one place where I would suggest you connect with me for all my ideas in one place. Friends, before I say goodbye in this video, a request. Please help us to reach out fellow like-minded smart traders like yourselves by sharing my video with your social media groups, your contact list, your family and friends, so that our free work can help other traders become better and more profitable traders. In the comment segment, do let me know how my work is helping you trade even better and what I can do to help make our videos even better for you. I thank you for your patience in being with me so long in this video. Till we meet again in my next, this is Vijay Bambani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.